Did you know that 2025 was supposed to be the year the global economy collapsed? Not just slowed down or softened, but actually broke under the weight of its own contradictions? That was the forecast you kept hearing from analysts, doom forecasters, and financial commentators. But here we are, stepping deeper into 2025, and the system is still standing. On the surface, at least. When you look closer, the cracks become impossible to ignore. By the time you reach the final minutes of this video, I'm going to show you 5 reasons the 2025 crash has been delayed, and number 1 will shock you because it exposes exactly what banks don't want you to understand. This isn't fear-mongering. This isn't hype. This is the stuff buried underneath the headlines, the stuff that shapes your financial future whether you pay attention or not. Most people imagine crashes as sudden events. One day the markets are up, the next day everything implodes, like 2008 or the dot-com bust. But that's the Hollywood version of a financial crisis. Real crises often move slowly, like a silent leak that nobody notices until the ceiling collapses. What's happening in 2025 is exactly that, a slow-motion breakdown that looks calm on the outside but is rotting from underneath. When I say delayed crash, I'm not saying the danger is gone. I'm saying the system is using every temporary patch possible to hold itself together. These aren't solutions, they're bandages on a bullet wound. Governments, central banks, regulators, and financial institutions are doing everything they can to avoid panic, not because the fundamentals are strong, but because the system can't handle the truth being exposed too quickly. Let's start with what the data is really telling us. Global GDP growth in 2025 has already been revised downward multiple times. What began as moderate optimism quickly turned into weaker than expected, then softening growth, and now low growth with elevated risks. That's economists speak for things are going downhill, but we don't want to scare you yet. You don't need to be an economist to understand the trend. When growth slows while inflation stays sticky and debt keeps climbing, the margins shrink everywhere. Households feel squeezed. Businesses feel squeezed. Governments feel squeezed. But the market headlines still pretend everything is under control. Why? Because if the headlines admitted the truth, investors would panic and liquidity would evaporate overnight. The forecasts show it clearly. Growth projections for multiple regions in 2025 are at levels normally associated with pre-recession environments. Not quite negative, but dangerously close. Small shocks that would have been harmless in a strong economy now have outsized effects. A minor trade disruption? Suddenly it's a major supply chain issue. A slight rise in bond yields? Suddenly it's a strain on entire industries. A shift in consumer confidence? Suddenly retailers are cutting jobs. This is what a weakened system looks like. Highly sensitive, easily destabilized, and dependent on constant intervention just to avoid collapsing. Trade tensions are a major contributor to this slow bleed. People underestimate how fragile global trade really is. Tariffs aren't just political weapons, they're economic grenades. Every tariff introduced by a major economy sends ripples through the entire global supply chain. Manufacturing slows. Shipping delays compound. Export-driven economies get hit first, and those losses cascade into currency pressures, debt risks, and shrinking foreign investment. Emerging economies are getting squeezed the hardest. Many of them rely on strong exports to service their debt. When exports fall and debt obligations rise, you get the perfect environment for silent crises, currency devaluations, reserve depletion, sudden capital flight. These don't make flashy headlines, but they're exactly the type of stress signals that precede global downturns. Inflation hasn't gone away either. It shifted forms, but it didn't disappear. Even though headline inflation dropped in some regions, core inflation, the one that actually reflects long-term price pressure, remains elevated. Prices aren't going down. They're stabilizing at much higher levels than before. People feel poorer not because prices are rising fast, but because they already rose too far and wages haven't caught up. Meanwhile, the debt burden from the past 10 years is still sitting on top of the global economy like a massive weight. Governments borrowed heavily during the pandemic. Corporations borrowed aggressively during the low-rate era. And households borrowed because everything, from homes to education to basic goods, became more expensive. Now we are in a high-rate world. Every unit of debt is more expensive. Every dollar borrowed is heavier to carry. Companies that survived only because interest rates were near zero are now facing reality. Those zombie companies, businesses that barely made enough to pay interest, but never paid down principal, are starting to struggle. In a low-rate world, they could survive. In a high-rate world, they're ticking time bombs. A wave of corporate defaults isn't a possibility. It's a timeline question. The crash is being delayed because lenders are quietly restructuring debts rather than forcing bankruptcies. They don't want a wave of failures to hit the economy all at once, so they drag out the inevitable. That's how you delay a collapse, but also how you guarantee it will be larger when it finally arrives. And now we arrive at the part banks don't want you to understand. Confidence is their lifeline. A bank doesn't run on money, it runs on belief. If depositors believe everything is fine, the system works. If depositors panic, everything collapses regardless of how strong the balance sheets look on paper. Banks know this. Regulators know this. Politicians know this. That's why they downplay risks, delay regulations, and release optimistic statements. There were supposed to be stricter capital rules kicking in earlier, rules that would have forced banks to hold more capital and reduce risk exposure. Those rules got postponed. That wasn't done to help the public, it was done to give banks breathing room, because the system couldn't handle stricter rules in its current condition. Even stress tests, which are supposed to reassure the public, are carefully designed to avoid causing panic. They model controlled disasters, not chaotic realities. A real financial crisis is never a neat simulation. It's messy, unpredictable, and amplified by human behavior. But banks pass these tests, publish the results, and expect the public to relax. Most people do. They don't realize that a system can pass a stress test while still being vulnerable to a non-linear shock, a type of shock that grows exponentially instead of linearly. One of the only reasons the crash hasn't already happened in 2025 is the massive inflow of investment into artificial intelligence. AI has become the new engine of market optimism. It's the storyline that keeps investors comfortable. Money flows into tech, valuations rise, and economies get a temporary growth boost. But the key word here is temporary. This isn't sustained, broad-based economic strength. It's a concentrated boom in one sector preventing the entire market from sinking. If the AI hype slows or fails to deliver near-term profitability, the correction will spill over into everything else. Meanwhile, governments are pretending they're in control of the situation. They're cutting rates, not because the economy is strong enough, but because the economy is too weak to handle higher borrowing costs. Rate cuts are supposed to be tools for stimulating growth, but in 2025, they're becoming tools for avoiding disaster. When rate cuts are defensive instead of proactive, you know the underlying system is fragile. Rate cuts are also losing their effectiveness. After more than a decade of manipulation, markets have become dependent on easy money. When money gets even slightly tighter, markets get nervous. When money gets cheaper again, the relief is temporary. You can't fix structural weakness with temporary liquidity. You can only postpone the consequences. So what would an actual delayed crash look like? Not a sudden stock market crash. That's too simple. More likely, you'll see a slow deterioration across multiple sectors. Corporate defaults rising quarter after quarter. Lending standards tightening quietly, making it harder for small businesses to access credit. Bond markets becoming more volatile, especially for countries and companies with high debt levels. Governments issuing more debt at higher rates, increasing fiscal strain. Unemployment creeping up slowly, not dramatically, but consistently. Household savings shrinking as costs stay high and income growth stays weak. These symptoms don't make dramatic news stories, so people ignore them. But they matter more than any headline. Why does every forecast keep pushing the crash forward? Because the interventions never stop. Central banks add liquidity. Regulators delay reforms. Governments issue debt. Banks restructure loans. Markets adjust to the new reality. And every patch buys a little more time. Weeks, months, maybe a year. But none of these patches fix the structural weaknesses. Excessive debt, fragile supply chains, inflated asset values, demographic imbalances, political instability. The more you delay the collapse, the bigger the collapse becomes. It's like stretching a rubber band beyond its safe limit. Each stretch adds more tension, and sooner or later, it snaps. And when it snaps, you don't get a normal recession. You get a large-scale unwinding of accumulated risk. Now, let's be clear, not every outcome is doom. There are scenarios, unlikely but possible, where the crash gets delayed again or avoided. If AI-driven investment continues creating real productivity, not just hype, it could create genuine economic growth that offsets debt burdens. If governments coordinate globally to reduce trade tensions, that could restore some stability to supply chains. If emerging economies adopt structural reforms, some of the worst debt risks could be contained. If central banks manage interest rates with precision, they could soften the landing instead of making the situation worse. These are all real possibilities, but they require competence, coordination, and discipline on a global scale. If you've paid attention to global politics over the past decade, you know those three things rarely happen together. The truth is this: 2025 isn't a year of collapse, it's a year of exposure. The system is showing its weaknesses openly. The patchwork solutions are no longer subtle. The excuses are running thin. And the illusion of stability is wearing off. People feel the pressure in their daily lives whether they understand the macroeconomics or not. They feel it in food prices, rent, interest payments, job security, the cost of raising a family. These aren't abstract problems. They're real, daily stresses that reflect a system operating at its limit. And that's why it's dangerous. When a system is under constant pressure, it becomes hypersensitive. Even small shocks can trigger major reactions. A political crisis, a corporate scandal, a sudden market correction, a spike in oil prices, a major bank announcing unexpected losses. Any one of these could be the catalyst that turns a delayed crash into an active one. You don't need fear. You need awareness. You need to watch the indicators that actually matter, not the headlines that comfort you. Watch corporate defaults. Watch lending standards. Watch government debt issuance. Watch long-term bond yields. Watch unemployment trends. Watch consumer spending shifts. These reveal the truth long before the headlines do. The delayed crash of 2025 is not a sign of strength. It's a warning. When banks don't want you to look closely, that's exactly when you should sharpen your focus. Awareness is your advantage. Blind trust is your risk. If this breakdown helped you see the hidden structure behind the 2025 slowdown, hit the like button. Drop a comment on what you think is the biggest threat ahead. And subscribe for more deep, uncomfortable, but necessary financial truth.